Taylor did not smile. On today's show, 3 questions. Number 1, how do I understand the unemployment metrics? Number 2, are millennials now the richest generation? And number 3, how many dentists are associated with the DSO in 2024? Let's go. Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
I'm Taylor.
And I'm Rabih.
Why are you laughing, Rabih?
I thought Taylor took too long, but it was fine.
You hesitated a little. I thought he was right on point. But
Thank you.
today is Hat Day, apparently, that I missed the memo on. Black Hat Day. Both looking great. I actually wore a black hat to the gym today. So, I could have brought it if I would have known. Thanks for the text message, guys. But excited to be here, as always, on this lovely Friday. Let's jump right in. Rabih, everyone is dying to know, how do I understand the unemployment metrics?
This is a question for me mainly, not for the audience.
Rabih's just so selfish on this show. He's like, I just want to talk about things that I'm interested in. One thing I will say really quick as you jump into this, Rabih, tell me if this is an accurate statement, that it, like the focus on inflation has now shifted to unemployment.
Correct.
Like that's now the main. It's just so funny how these things happen. But what was once the biggest focus, being inflation, has now dissipated, and now it's like we're like looking and waiting for every reading of unemployment. Is that a fair statement?
That is very fair, because now the risk shifted from the upside of the economy running loose and running too hot to the economy slowing down and us not acting. By us, mean Federal Reserve not acting fast enough. So yes,
got it. We've said this before, but I got to just say it again. Like the job that Chairman Powell has and his team is like, imagine the pressure.
Yeah,
you go from one end of the spectrum of like you didn't act fast enough to lower inflation, and now it's like, are you going to cause a recession? Like the amount of pressure those people are under is just wild to me. Okay, let's jump in though. You've mentioned that there's the unemployment metrics, but there's kind of different ways to interpret this or to break this down. So why don't we jump into that?
Yeah, sure. Because honestly, we collect more data about unemployment than we did about, inflation. Inflation, we had the CPI core, PCE core. That was about it. We're looking at these unless you really want to nerd out, which I don't think people would want that on this podcast. But with unemployment, you get a lot of reports. And this week, actually a very strong week for the US stock market, around 5% return just for the week, coming off the dip / correction that happened earlier by the end of last week, all the way till Monday. And a big contribution for it were reports that came related, they were related to like the growth of GDP, but also related to the unemployment rate. And we got 2 reports. The first one is called Initial Jobless Claim, and the other is called Continuing Jobless Claims. And I'll explain those in a second and what they mean, but just looking at them, it's like, how will that tell me what the economy is doing, and how do we know whether employment is going to head in the right direction or not? So I thought I'll just throw in at you all the reports that we actually look at, and from there we'll understand where these reports fall in the bigger picture. Like, where do they fall? So unemployment is mainly just our indicator whether the labor market is in balance or not. And for the labor market to be in balance, you need to have a certain amount of jobs and job openings in a sense, and a certain amount of unemployed people. And you would want them to be very close to each other. The amount of jobs available is equal to the amount of people who are willing to work these jobs. Every economy, based on its infrastructure of how they mainly draft their employment laws and stuff, determine a base level of unemployment that a country can't go below. So if you come and tell me, hey, there's this country that has a 0 unemployment, it doesn't happen. The US has been averaging around 4 for the last couple of years. Europe, their unemployment rate is usually around 6 to 7%. Each and every country, usually developing countries, they have around 11-12% of baseline unemployment. We call it the natural unemployment rate. So each economy has its own different features that determine a certain equilibrium rate for unemployed people, regardless of whether there are job openings for them or not. So when you think of a labor market that's imbalanced, first thing you think about job openings, and the second thing you think of, and that's measured by like payrolls that are available, And then you can look at the unemployment number, like the people who are unemployed. And the people who are unemployed is actually derived, just like think of a pyramid, from the population, and you narrow it down to all the people who can work. So you start with the US population as a whole, and then from it you take the working age population. We're talking 16 to like 65. That is usually what they look at. And out of that working age population, that's not what we call the labor force. The labor force are only the people out of the working age population that are willing to work. So some people say, I do not work, retirees. Those, although someone who's retired in their 50s, they are from the working age population, but they choose not to work, and they are not counted in the labor force. And the difference between them, like what percentage of those who are in the working age group decide to work, is what we call the participation rate. And that's a report that we get every single month. How much of the people who are in the working age population choosing to work, aka being considered in the labor force, is their participation rate. And that participation rate actually increases or decreases based on how good the consumer feels about themselves. In tough times, it'll go up because people will rush to find jobs.
So Rabih, this is why the way you just described that explains why when people talk about like the headline unemployment rate being at like, let's say 4%, or the most recent reading 4.3, I think it was, is actually lower than the actual unemployment. Like it's always higher, or like because that's only, you're saying that's only counting people that are actually willing to work that are not working. It's not counting people that are just pull themselves out of the workforce.
100%. So okay. Those people who choose not to participate and be part of the labor force are not even counted in the unemployment rate. Here's where we go to the next level.
Rabih, you know how they like determine that? Is that if they're drawing Social Security, they're taken out, or like what's the
actual surveys?
Okay.
Census data and stuff. This is how they get those. Also, a lot of time in economics, when they are reporting, they have a number that is a residual. They figure it out to balance the equation on both sides. And one of the ones are the participation rate. It's a residual balance. So we've got the labor force, which are the people in the working age population who are willing to work. And in the labor force, it's divided into two people. People who are actually employed, are in jobs, and people who can't find a job because they got laid off. Those people who can't find a job as a percentage of the labor force, and again, the labor force is people in the working age population who are willing to work, is what we call the unemployment number, the number of people unemployed. So those unemployment number, this number should actually match, the job openings for your economy to be in balance from a labor perspective. That number as a percentage is what we call the unemployment rate. And the unemployment rate is simply the number of people who are unemployed, who are part of the labor force, divided by the people who are in the labor force. And that's how we calculate that number. However, that report, the unemployment rate report, only also comes once a month. So, the market likes to get ahead of itself. They try to anticipate what the unemployment number is going to be like. So they go around and dig for other sources of information to hopefully be able to predict what the unemployment rate is going to be month over month. Two of these reports is called the initial jobless claims and the continuing jobless claims. And let me read the description for you and what it says. Initial jobless claims refer to the number of people who have filed for unemployment benefits with their state's unemployment agency for the first time during a specific reporting period, typically on a weekly basis. And the continuing jobless claims are the actual number of unemployed and currently receiving unemployment benefit who filed for unemployment benefits at least 2 weeks ago. So they go to the state agencies, they get unemployment data, they see how many people filed for unemployment, and they compile them every single week. That's the beauty of this report. It comes out every single week. You get 3 weeks of data that help you predict what the unemployment rate is going to be by the end of the month, because that is all of these are lagging indicators, but instead of it being a 1 month lagging indicator, it's a 1 week lagging indicator. So the market, especially when unemployment is the talk of the town, like what we're living in right now, they will actually look at these unemployment numbers, claims in a sense. And it happened that while the continuing jobless claims has been on its average around 190K every single week, of people. The initial jobless claim is actually not increasing as it usually increases. Usually, you can think of 260K, 270K every single week filed to unemployment. But also 2 weeks later, 3 weeks later, they might find the job,
they
and
get a
that
job.
number will go down. So on average, it's around 200 are filing for unemployment for the first time. The data that we received and why the market received it so positively was around 230K, which still means it's not even at the average. So maybe the 4.3 was just a blip, and due to summer sales, because July was a really good month, retail sales were really high, those numbers might have dropped and it was just a blip. This is changing the narrative. This is putting more weight on the soft landing. This is telling the Federal Reserve, hey, okay, even if you want to wait till September, you're not going to make us hit a wall so quickly. And the market reacted so positively. So from now on, we're going to be getting the unemployment rate, the participation rate. Every single week, we might have the initial jobless claims and continuing jobless claims. And we're going to look at those to see and give us an indicator of whether unemployment will actually be a problem or not. And the reason why we focus on unemployment, because it is the most straightforward indicator whether we're going to have a slowdown in the GDP, economic activity, or not. Because the economy grows as a function of technological progress, like productivity, as a function of more capital pumped into it, aka factories, mines, all these stuff that take time to develop and exit, and people who are working, the labor. And that is the most sensitive aspect. And the ones who are spending. And this is the most sensitive aspect. So it's our best indicator for whether the economy is going to still be growing according to its trend, or it's going to be going through a slowdown or a recession.
Got it. So the initial jobless claim report came out, wasn't nearly as, it was below average. This was just on the heels of the unemployment rate that came in at 4.3, indicating the SOM rule had been triggered. People were freaking out. But now it seems like people have kind of backed off that.
Yeah.
Do we
it looks like we overreacted to a data point. But this is a data point that made us...
It doesn't sound like us.
It doesn't sound like us.
No.
But this is a data point that made us chill. So probably next week, if the number is bad, we're going to overreact
again. Okay.
It's gonna
Perfect. I like this. Really quick, I know you didn't prepare this, but you and I talked yesterday, I think, or the day before, about the Fed lowering rates in September. It's all but a given at this point. Is that where we're at?
Because the Fed communicated it. It was the first question they asked Jerome Powell after their meeting minutes, and it was like, "Is it on the table?" It's like, "It's yes." He was very clear that it is on the table.
Okay.
And you look at what the market thinks of his statement through the Fed funds rate. The probability that the first cut is happening in September it's not budging from 99%. So,
got it.
Yeah.
Taylor, I don't know what you're seeing, but I've seen this recently multiple times over the last week that rates are already coming down. We're seeing this. I mean, and because, as we've said so many times, and Rabih, tell me where I'm wrong here, but the Fed funds rate, which is what the Fed controls, the overnight rate that banks are lending to each other, that's what the Fed is focused on. A lot of the rates that dentists are out there focused on, let's say mortgage rates, let's say rates that impact financing for a practice of any kind, real estate, those are attached to the 10-year Treasury most of the time, and so those rates are impacted by more market dynamics and supply and demand dynamics rather than just what the Fed is doing. So I'm already seeing rates come down pretty decently, kind of surprisingly. Taylor, are you seeing the same thing right now?
Yeah, I've seen the same thing. And the biggest thing that I've noticed is these lenders, they kind of adjust the terms of their loans based on the interest rate. It seemed like for a good minute there, all practice lending was done on a 10-year loan schedule. And then recently I've been seeing, just with the interest rates increasing, I've been seeing 12 and even 15-year.
I've seen the same thing. Yeah, shocking.
Right. So I'd be curious to see, with rates coming down, if they're going to drop that rate, or not the rate, the term of the loans back to more of a 10, 12-year period. Because the most recent ones I've been seeing is the 15, which, it just seems like this lending, their interest rates are one thing, but at the end of the day, the biggest thing that most people are concerned about is what's my monthly payment. Right.
Always. Yep. Which makes sense why these banks probably saw a hit to the amount of loan applications coming in, because they were stuck on that 10-year. And to your point, they know just as well as we do, people focus on, well, what's my monthly payment? So if rates go up, they extend the term, lower the payment. The bank loves it. They're still making their interest. So yeah, you're right. It'll be interesting to see what happens if they start to lower or as those rates come down. So, okay. Anything else, Rabih, on any of that? Feeling good? Are we freezing? Am I freezing?
A little bit, but
Okay.
I'm following.
Okay, we're good. All right. Okay, let's shift gears a little bit. I saw this article. I was kind of interested in this article more than anything. It was all around the millennial generation and how wealthy the millennial generation has become compared to generations in the past. And the reason I was so interested in this is because, and I want to hear from you guys, I have always kind of been on the kind of like assumption, or I've kind of always kind of heard this narrative that the millennial generation is so far behind everyone else. Is this something you guys have heard too?
Yeah.
It's the worst.
And that they'll
It's
never
the
be
worst.
as rich as their parents, right?
Yeah, they will never be as rich as our parents. I think I read several times that we are the first, and I say we as in I'm millennial. I think you two are both millennials. What are you, Rabih?
Gen Z.
Gen Z? Oh my gosh. Okay, well, we got to kick you off this podcast. No, I'm just kidding.
Here's my biggest complaint, Matt, is I'm a millennial like you. You're definitely like on the higher end of the millennial. We're still in the same band.
I'm on the older side.
It felt like for years, millennials got made fun of by the older generations. And then Gen Z comes along and I'm like, all right, someone else is going to get the target.
Lost him.
Oh, am I back? Back?
You're back.
What I was saying is it just felt like for years, the older generation made fun of the younger generation. And I was excited for Rabih's generation to come in and be like, all right, people are going to start making fun of Gen Zs. But you know what happened? Gen Zs just started making fun of millennials. We're just
so
from both sides.
Oh,
you're welcome, I guess.
it's so true, man. That is such a good point. We have a couple of Gen Zers in the office, like Rabih being one of them. I didn't realize Rabih was a Gen Zer, mainly because you don't make fun of me the way that our other Gen Zers do. But I do get made fun of a lot. I'm officially like one of the old guys in the office. I mean, Taylor makes fun of me. He's a fellow millennial with me, but we digress. The main focus, or the main thing I wanted to talk about from this article that I found fascinating, again, it's kind of a theme we talk about on the show all the time, which is narrative often does not match reality. And this look no further than, again, this exact topic, which is millennials being the first generation ever to not be as wealthy as their parents and to not continue on like carrying that flag of like continued growth. Well, that has been completely debunked. Millennials now are doing better than past generations, Gen X and baby boomers at their same age. So I'll just throw a couple of numbers here and then we'll move forward. And the main thing we want to talk about is Taylor's topic of DSOs, but I did think this was interesting. So the real median household net worth of older millennials, as Taylor would call me, born in the 80s. So I guess I'll back up. Millennials being 1981, born in 1981 to 1996. That's the millennial generation. So the older millennials, so those born in 80s, me, the real median household net worth rose to $130,000 in 2022. That is up from $60,000 in 2019. I don't have the data of 2024. I would imagine that 130 is even significantly higher. The real median net worth of millennials born in the 90s, so the younger generation or the younger kind of cohort, had their net worth quadruple to 41,000 is the median point, up from like below 10 over the last couple of years. So this is the key point here. According to a report by the St. Louis Fed, millennials adjusted for inflation have 25% more wealth than Gen X or baby boomers did at their same age. So this whole idea that millennials are behind or they're not doing as well or the first generation ever to not do better than their parents, from a wealth perspective, not true. It's just not true. Last data point here, Rabih, I told you this before, but this blew my mind. The collective wealth of millennials and the older Gen Zers, which, Rabih, that's you. You're on the
That's
older
me.
side of the Gen
Yes.
Z. So the millennials and the older Gen Zers is now a collective 14.2 trillion in 2024. That is up from 4.5 trillion just 4 years ago. So the
Wow.
level of wealth created of this generation, the millennials and even the older Gen Zs, within a matter of 4 years, just completely caught up. And we've now debunked this whole idea that, again, millennials are so far behind. We are now further ahead than the past generations. Any thoughts on any of this?
Actually, I think now the numbers reflect reality, because like millennials and Gen Z are not starting from scratch. And what I mean by scratch, they're creating their own civilization from scratch. They're building upon what previous generations have provided and the infrastructure that was laid there, and the advancement in technology and productivity that all should, the law of one price should be reflected in better quality of living and better paychecks.
Yeah.
So
Yeah.
I think now the numbers actually reflect a logical explanation of progress.
I do have, I mean, these are questions that you can't answer, or we can't answer probably from this article, but I am curious. Two things about those numbers is, one, the difference was 2019 to 2023, correct?
The numbers they quoted were from 2019 to 2022.
2022.
Yep.
So, and I'm curious, just because, home ownership is obviously the biggest, form of generational wealth and passing things on. And I know a lot of millennials have purchased homes, and in the last 4 years, we've seen a real estate boom. So
Yep.
I'm assuming a lot of that net worth growth has come from real estate. And then the second thing that I would be curious on is, our parents' generation, a lot more were dependent on pensions, and the companies, they're going to provide for you in retirement. Whereas I feel like the millennials have been educated a bit more, not a lot, but a bit more, as like, hey, this is on you now, right? You need to be building your own wealth. You need to be investing yourself and taking care of yourself, because there is not going to be a company there to take care of you in retirement. So I'd be
Yep.
curious just to see like how that has affected millennials and the way we handle our finances.
I think it's huge, Taylor. It's a great point. They talk about in the article real estate being a huge factor, that millennials in a lot of ways, depending on where you're at in that cohort, like I am a testament of this, of just good timing of being able to get into a house before like the hockey stick growth of real estate. I think that happened to a lot of millennials. That's big. And then to your point, retirement savings. So millennials are now kind of part of this. The number of 401k plans out there that are like automatic enrollment has increased dramatically. There's rules changes, across the board that have been put in place, that more and more, there's more benefits for companies to do automatic enrollment. So 401k, they quote a lot of numbers around like how much 401ks and retirement plans have grown. Also, we're in the midst of a great market the last 4 or 5 years. So I think that's really helped as well, to that point, Taylor. And you're absolutely right. I think we probably are the first true generation, like maybe Gen Xers, but millennials really are in the true, or the ones that were not born into like any level of pension. Basically, like the expectation of a pension has never been there for millennials. So I think you're totally right, Taylor. It's like shifted the mindset. And I think even more so for Gen Zers as well, that like you got to do it yourself. I think it's a big difference there. So Rabih, any other thoughts on this at all?
Yeah, all good.
All good. Okay, let's jump to the last topic here. How many dentists are associated with the DSO? Taylor, I know you've got a lot of data here. This is super fascinating and obviously very pertinent to our listeners. Huge topic that we are talking to individuals about all the time. But yeah, let's talk about the data that's talking about how many dentists are now associated with DSOs versus private practice.
Yeah. So I guess my first reaction, so this data came out, it's from the ADA. So, and specifically, it's from the Health Policy Institute at the ADA. And so what they did is they went through all the dentists, practicing dentists, and they saw if they could like associate an address with that dentist. And so these this data point, or these data points, come from 193,000 out of the 203,000 practicing dentists. So almost 95% of dentists are accounted for in this sample size, which is pretty great data when you're doing this, right? So for me, this was just really, really instructive, just because you hear a lot of like fake stats when it comes to DSOs. You know, I feel like depending on who you talk to, the numbers are really, really big or really, really small, right? And it's just serving a purpose. So this was the first time where I got data and it like felt, hey, this is coming from the ADA, this is coming from legitimate sources. And I was both shocked on the high end and low end at some of these numbers.
Yeah.
Right. So the first thing I would say is one of these charts is just showing dental practice size based on, you know, are you single location, single doc, single location, multiple doc, 2 to 9, 10 to 50, 50 to 100, or 100 plus locations, right? And the first data point that I thought was interesting is out of all dentists, about 75% of dentists are in single location practices.
That shocks me a little bit.
Right.
Should it not shock me? Did that shock you?
It did. It was shocking. I was like, oh, that seems higher than I thought.
Yeah.
Right. So 75% of dentists are in single location practices. Now, of that 75, 35% are in single doc, single location. And then the other 40% is single doc single location multi-doc. So, you know, one to 2 plus associates, right?
Yep.
But for the most part, you know, 75% of the industry is still in single location practices.
Yeah, that I would not have guessed that high.
Yeah.
But that's good to know.
Now it's interesting, then they break it down based on, you know, up to 10 years out of dental school, then they do 11 to 25, and then 25 plus. And the number shrinks a lot more if we're talking people who are within the first 10 years of graduating dental school, right?
Yep.
Would make sense, right? People getting their first jobs, a lot of them are going to be a lot more associated with larger practices where there's more associates and openings from that front.
Yep.
But if you look at that, only about 16%, so 20% less, are in that single doc, single location, which to me, again, that's going to be private practice owners for sure.
Yeah.
Right. So only about 16% for sure in that single doc, single location. And then if you look at people over 25 years of, you know, since dental school, that number jumps to 48%.
Or almost 50%. Yep.
Right. And then another 36% are in single location with an associate or two.
Yeah.
Right. So it just shows what you'd expect. You know, older docs are more in practice. Right. Next graph that I thought was interesting was just the trend of DSO affiliation over time. Right. So if you look back in 2015, that number was 7%. Right. 7% of doctors or dentists were associated with DSOs. And that number has grown about 1% or more every year up until 2023, where we're just below 14%. So in the last 8 years, basically the amount of dentists working for DSOs has doubled.
That's wild. It's still, that number is still lower than I've been quoted by a lot of people in the industry. So to your point, Taylor, it's good to get this data that feels from a more reliable, objective source than maybe other sources we've heard. That it's just that's not as high as I thought.
And I had the same reaction, Matt. I was like, that's not as high as I thought. But it's also, when you think about this data represents 200,000 dentists.
Yep.
So a 1% increase is 2,000 dentists switching from private practice
to DSO. It's DSO, a lot.
Which is a lot, right? That means, you know, some of those are going to be new grads just working for DSOs, but the majority of those are going to be dentists selling their private practices to DSOs.
Yeah. Yeah.
Right.
Yeah, that's a good point though, because we have probably 6,500 graduates a year of dentists coming out, something like that. And so I don't think this data shows that, but it would be I think a good percentage of those, I'd imagine that a large percentage of those compared to maybe 5-10 years ago are coming out and going straight to DSO versus before where they would go private practice and then into ownership pretty quickly. But you're right. I mean, a 1% increase and truly a doubling over an 8-year period is significant. It's just that the actual percentage now where we're at is just lower than I would have guessed. If you would have asked me, where do I think it is now? I would have probably said 25-ish%.
And there are states, they break it down by state. So there are states where they are as high, so we're talking, there are in this data about 8 states that are 20% or more. Right. So if you are
the winner is Colorado.
Yeah, Colorado is almost 25. We're talking 23.3.
Yeah.
Which is a lot. One of 4 dentists is a lot.
Yep.
So if you're in the states of, what is that? Arkansas, Florida, Wisconsin, Arizona, Texas, Georgia, Nevada, Colorado, you're north of 20%.
Interesting. I wonder what the dynamics are there for those states in particular that would increase the likelihood, whether it's just like demographics, if it's insurance issues within those states that lead to a higher likelihood of DSO activity. That's interesting.
Yeah, state legislation. It'd be interesting to see if a non-dentist can own a dental practice in those locations.
Yeah, exactly. Interesting.
So I found this information fascinating. I honestly feel like we should do like a webinar or something else where you can actually see the numbers. Like you and I and Rabih, we're looking at these charts. Obviously, the people listening, it's a lot harder, but it's pretty fascinating just to kind of see it broken down from a unbiased party that, we've got 95% of the dentist population represented here.
Definitely. Yeah, no, I think this is really fascinating. You're right, Taylor. We probably should do some type of webinar on this so we can share the visuals, talk about it, maybe bring on someone, I'm thinking of like a Mike Baird or someone in this space that specializes, in this area that could give us a different perspective on this. But I'll just share my takeaway, which I've already shared, which is just kind of surprising. And I'll be honest, I'm kind of, I think this is I look at this as positive in the sense of whenever we get pushback from dentists, or I wouldn't even say pushback, whenever we get dentists that are nervous about like, oh my gosh, like, is private practice even still viable? They're getting a lot of things thrown at them. Let's be real, from people who are incentivized to tell them you should be scared and you're going to miss this train and you should hop on now. Maybe I'm thinking about this the wrong way. Tell me if I am, but I look at this data and say, there's still 75% of dentists that are in private practice. Like, I think a DSO looks at that and says, holy cow, tons of opportunity to go buy practices.
Yeah.
But I look at that and say, hey, private practice is still very viable. So it's kind of both things can be true. Rabih, you're nodding your head at that.
I agree with you. Yeah.
Yeah. I had the exact same reaction, Matt. Exact same train of thought. My thought was, a lot of people that are considering these DSO offers, the biggest sales tactic that I see happening is like, don't miss the boat. Don't miss out, right? This isn't going to be here forever. But the honest truth is that there's still a long ways to go, right? And there's still a lot of consolidation happening. And so if you're in that boat where you're like, I don't really want to sell to a DSO right now, but I could see myself doing it in the next, 5 years or so. Like I've seen a lot of like late 40s, early 50s where they still want to practice dentistry for another 10, 15 years, but they're getting a lot of pressure to sell their practice to a DSO now. And they're not entirely comfortable with it. I would say it's okay to wait, right? They're going to tell you, I've yet to hear a DSO pitch where they're like, if you don't get in now, you're going to miss out on this recap that's coming next year. It's like, oh man, there's so many recaps that are happening next year. It's amazing.
Yeah. And hey, by the way, there might be, if rates continue to come down and cost of capital comes down, like there could be. But to your point, Taylor, we hear that every single year. We hear that every single pitch, every single month, or that is the pitch. Like, get in because you're going to get a recap next month. It's like, okay, we've heard that before.
Yeah. But the point here is like, there is time, right? You still have time. Don't feel pressured. Don't feel like you have to make a decision because someone is breathing down your neck and saying, do this, do it now.
Yeah,
right?
Totally agree. Rabih, you had thoughts on this.
Yeah, no, just to add on Taylor's point, when only 14% of the market is owned by DSO, it just tells you that it's a buyer's market, not a seller's market.
Yeah.
So just moving away from dentistry and just looking at it economics wise, this is still a buyer's market.
Yeah, definitely. And Taylor, to that point, like to say that this train will eventually stop is true in the sense that private equity has a very repeatable cycle that we've seen in other markets, right? Look at the MD space. Like eventually multiples will come down. Eventually the market will be fully consolidated. Like that will happen. And depending on who you talk to, that's anywhere from 65 to 70% of the market, all the way up to like 80+%. I think if you look at comps and you talk to people in the private equity space that are going to give it to you straight, they're going to tell you it's somewhere probably around that 70% full consolidation is what they consider full consolidation, meaning that there's still always going to be a space for private practice, even at quote unquote full consolidation. The market is not going to get to 100% consolidation. That is not what quote unquote full consolidation means in the private equity space. So Taylor, to your point, this whole idea, first of all, I tell this to people all the time, never make a decision as a general rule, never make a decision out of fear. Whether that be, and all greed is fear of missing out. So the FOMO of like, oh my gosh, I'm going to miss this train. Oh my gosh, I'm going to miss this recap. Oh my gosh, this is never coming around again. It's just not true. And it's just, as a general rule, you never want to make a decision from that place. Make a decision from a place of being grounded and saying, this fits my plan for my life. And like, I can point to all the reasons why this makes sense for me, not, oh my gosh, I'm going to miss this recap, once in a lifetime opportunity. If I ever hear that, which I heard this as recent as like a few weeks ago, run. If someone is telling you this is a once in a lifetime, no brainer opportunity, they are trying to sell you something, and it's not in your best interest in most cases. Any final thoughts on any of this, guys? Rabih's like, no,
Amen.
It's great.
Amen.
Amen, brother. Okay, guys, this was great. I love just how many different kind of topics we're jumping to. I hope people enjoy it. I hope it's helpful. I think we will take this DSO topic and take it to another level and do a webinar. We should put that together. So we'll talk more about that. Look for that coming soon. As always, thank you so much for listening. If you want to talk to us, if you want to tell us that we're wrong, we would love to hear that. Either go to our Facebook group or set up a consultation at dentistadvisors.com. We would love to talk to you, hear your story, see how we can help. Rabih, Taylor, thank you so much for being here. Everyone, thank you so much for listening. That was our 2 cents. Have a great weekend. Bye-bye.